Top 10 Financial Tips. Do not forget to like, share, subscribe and ring the bell for more videos. Although making resolutions to improve your financial situation is a good thing to do at any time of year, many people find it easier at the beginning of a new year. Regardless of when you begin, the basics remain the same. Here are 10 key tips to getting ahead financially. 1. Get paid what you're worth and spend less than you earn. It may sound simple, but many people struggle with this first rule. Make sure you know what your job is worth in the marketplace by conducting an evaluation of your skills, productivity, job tasks, contribution to the company, and the going rate, both inside and outside the company, for what you do. Being underpaid even by $1,000 a year can have a significant cumulative effect over the course of your working life. No matter how much or how little you're paid, you'll never get ahead if you spend more than you earn. Often it's easier to spend less than it is to earn more, and a little cost-cutting effort in a number of areas can result in savings. And it doesn't always have to involve making big sacrifices. 2. Stick to a budget. An important step to consider when trying to get ahead financially is budgeting. After all, how can you know where your money is going if you don't budget? How can you set spending and saving goals if you don't know where your money is going? You need to set up a budget, whether you make thousands or hundreds of thousands of dollars a year. 3. Pay off credit card debt. Credit card debt is the number one obstacle to getting ahead financially. Those little pieces of plastic are so convenient to use, and it's so easy to forget that it's real money we're dealing with when we whip them out to pay for a purchase, large or small. Even when we resolve to pay the balance off quickly, the reality is that we often don't, and end up paying far more for things than we would have paid if we had used cash. 4. Contribute to a retirement plan. If your employer offers a 401(k) plan or another type of employer-sponsored retirement savings program, you should consider contributing to it if you can afford to. Often, with 401(k) plans, your employer will contribute the same amount that you put toward your account up to a certain percent. This is often referred to as an employer match. If your employer doesn't offer a retirement plan, consider an IRA. 5. Have a savings plan. You've heard it before, pay yourself first. If you wait until you've met all of your other financial obligations before seeing what's left over for saving, chances are you'll never have a healthy savings account or investments. Resolve to set aside a minimum of 5% of your salary for savings before you start paying your bills. Better yet, have money automatically deducted from your paycheck and deposited into a separate account. 6. Invest. If you're contributing to a retirement plan in a savings account and you can still manage to put some money into other investments, all the better. 7. Maximize your employment benefits. Employment benefits like a 401(k) plan, flexible spending accounts, medical and dental insurance, etc., are worth big bucks. Make sure you're maximizing yours and taking advantage of the ones that can save you money by reducing taxes or out-of-pocket expenses. 8. Review your insurance coverages. Too many people are talked into paying too much for life and disability insurance, whether it's by adding these coverages to car loans, buying whole life insurance policies when term life makes more sense, or buying life insurance when you have no dependents. On the other hand, it's important that you have enough insurance to protect your dependents and your income in the case of death or disability. 9. Update your will. In 2021, just 33% of Americans had a will. 1. If you have dependents, no matter how little or how much you own, you need a will. If your situation isn't too complicated, you can even do your own with software like Quicken Willmaker from Nolo. To better protect your loved ones, consider writing a will. 10. Keep good records. If you aren't careful about keeping thorough records, you're probably not claiming all your allowable income tax deductions and credits. Set up a system now and use it all year. It's much easier than scrambling to find everything at tax time, only to miss items that might have saved you money. Checking in. How are you doing on the above checklist? If you're not doing at least 6 of the 10, consider resolving to make improvements. Choose one area at a time and set a goal for incorporating all 10 into your lifestyle. Frequently asked questions, facts. Where can you get financial advice for free? You probably won't find good investment ideas for free. Financial advisors make a living offering their advice, so good ones will charge for their services. Other types of financial advice may be provided for free, especially if you have a low income. For example, if you need help with taxes and your income isn't more than $73,000, then you can use the IRS Free File Program. 2. A credit union or local nonprofit agency may be available to offer free or low-cost debt advice. What's the best way to measure financial success? There are several methods of measuring financial success, and the best will depend on exactly how you define success. If you define success as being able to live comfortably, then you can measure it by comparing your income to your expenses and making sure you have plenty of money to pay your bills. Others want to see year-over-year net income growth by earning more and controlling their spending. You can also measure the financial success of individual efforts in projects with financial ratios like the return on equity, ROI. Is a college degree necessary to achieve financial success? A college degree is not required to achieve financial success. However, statistics consistently show that higher levels of education are associated with higher income and lower unemployment rates. In other words, you may not need a college degree to achieve financial success, but the odds are that it'll help. What is personal finance? Personal finance describes how you save, spend, and invest the money you have, your financial resources. If you're good at managing money, then you're good at personal finance and vice versa. Money touches every fabric of your life. When you don't know how to manage it properly, it may lead to anxiety, stress, and a whole lot of headaches. However, when you master the concepts of personal finance, it may lead to freedom, happiness, success, and security. Here's how to do it. Definition and examples of personal finance. Personal finance is a concept used to define how well you manage your money. It takes a look at how you spend, save, protect, and invest your financial resources to create the type of lifestyle you want to enjoy. Personal finance covers a range of topics, including income generation, budgeting, banking, insurance, loans and mortgages, investments, retirement planning, tax and estate planning. Personal finance is simply the approach we take to using money, said Todd Christensen, AFP Debt Reduction Services and author of Everyday Money for Everyday People. According to Christensen, examples of personal finance might include planning your monthly spending, balancing your checkbook or debit account, transferring money from your checking account to your savings account, setting up direct deposit for an IRA, taking only the cash you plan to use on groceries into the store so you don't overspend. How personal finance works. You may have heard your grandparents say, live below your means and save the rest. This is the essence of personal finance, making smart decisions with your money now, so you have freedom and options later on. Personal finance is more than budgeting, said Lauren Zangardi Haynes, a CFP, CIMA, and CIPA at Spark Financial Advisors. It's understanding credit cards, how compound interest works for you, or against you, understanding Roth versus pre-tax savings, planning for a rainy day, making housing decisions, and saving for college and retirement. It's interwoven in our daily lives at every corner. Zangardi Haynes went on to say that understanding personal finance is key to reducing anxiety around money. You don't have to be an expert. You just need to know the basics. How can you be good at personal finance? Being good at personal finance is all about making your money work for you, regardless of how much you have. Money touches every aspect of life, and if a person doesn't know how to manage it, then it can lead to a lifetime of headaches and stress, said Ksenia Udina, CFA, founder and CEO of Honest. Once a person gets a handle on their finances, then they can spend time focusing on the things that matter most in life. Here's how to get good at personal finance. Set clear financial goals. Everyone has a vision of what financial success looks like to them. Maybe for you, it's having a credit score over 800, retiring by age 50, or helping your kids avoid the student loan squeeze. For others, it may be driving a luxury car or owning a second home by the beach. Whatever your goals are, you must create a clear framework for achieving them if you want to be successful. Be smart about your goals. Make them specific, measurable, achievable, realistic, and time-bound. Smart. Start budgeting. Learning to budget is one of the basics of personal finance. It involves tracking your income and expenses so you can see where your money is going each month. When done right, a budget puts you in control of your money. It gives you the freedom to spend more on things you love by spending less on things you don't. There are a lot of budgeting apps to help you automate the process. Build an emergency fund. If you always feel like you don't have enough money to pay the bills, an emergency fund could provide some relief. It's one of the basics of personal finance because it gives you a safety net to fall back on if something unexpected happens, such as your car breaks down or your cat needs an emergency vet visit. Many financial advisors suggest you keep 3 to 6 months of basic expenses in a savings account for your emergency fund. If that seems out of reach, start small with a $1,000 starter fund or 1 month's worth of expenses. Anything is better than nothing. Pay off debt. Getting out of debt can be challenging, but there are a lot of reasons why you should do it. Becoming debt-free increases your financial security, gives you more money to spend on things you enjoy, and improves your credit score. Making a plan to pay off your debt can be one of the best things you do for your personal finances, especially if you have high-interest debt. Eliminating high-interest debt should be a top priority when it comes to personal finance, said Udina. This type of debt can quickly spiral out of control and derail any financial plan you have in place. Start saving for retirement. Saving for retirement has all types of benefits. You can deduct contributions from your taxes, you build up a nest egg for the future, and you may get free money if your employer offers matching contributions. Many financial experts recommend saving 15% of your pre-tax income for retirement. Point 1. If you're not saving anything at the moment, contribute at least enough to get the full employer match, if one's available. After that, consider maxing out a Roth IRA, then going back to your 401k. This is a popular retirement savings rule of thumb people follow. Stick with it. The goal of personal finance is to spend less, so you have more money to save and invest. Although it's a simple concept to grasp, it can be difficult to stick with it when you're constantly bombarded with marketing messages telling you to buy more. Each time you go to make a purchase, ask yourself, does this item bring me one step closer to the life I want to live? Will I enjoy this purchase, or am I just buying it to buy it? By asking yourself questions like these, you align your spending with your values and minimize your chances of wasting money on something that puts you farther away from your goals. Increase your personal finance literacy. When you have financial literacy, you understand all the facts, tools, and principles you need to be smart with money. Unfortunately, financial literacy isn't taught in many U.S. school systems. It's up to you to seek out this information if you want to be successful with your finances. Stuck on where to start? Here are 3 resources you can tap into to increase your personal finance literacy. Personal finance podcasts. Some personal finance topics can be confusing, even dull, especially if you're new to it. Podcasts that break topics down in clear, inviting ways can help you better visualize how they apply to your life. There's no shortage of great personal finance podcasts to listen to and learn from. Personal finance books. Reading personal finance books is also a great way to learn how to manage your money better. Books cover all the personal finance basics, including how to invest, pay off debt, change your money mindset, increase your income, and more. Roth 401k versus Roth IRA. What's the difference? Saving for retirement is an important piece of everyone's financial plan. Many people use specialized retirement accounts to save because of the tax incentives that they provide. Roth 401ks and Roth IRAs both let you contribute money after you've paid income taxes on it. In exchange for restricting withdrawals until you retire, you can withdraw the money, plus any earnings, tax-free. Roth 401ks and IRAs are alternatives to traditional 401ks and IRAs, which provide a tax deduction on contributions instead of allowing tax-free withdrawals. The most significant differences are in who can open each account and how much you can contribute. 401ks are offered through employers, while IRAs are available to almost everyone. What's the difference between a Roth 401k and a Roth IRA? While both Roth IRAs and Roth 401k plans allow for after-tax contributions, the retirement offerings have some big differences. Eligibility. The most significant differences between a Roth 401k and a Roth IRA are the eligibility requirements to open one. Like traditional 401ks, Roth 401ks are offered through employers. To open one, you need to work for an employer that offers the plan as a benefit to their employees. Unless you have your own business or are self-employed, you can only open a 401k through an employer. By contrast, anyone can open a Roth IRA, even if their employer doesn't offer one. There are also income restrictions on who can contribute to retirement accounts. Roth 401ks don't limit contributions based on your income. You can contribute as much of your income from that employer as you want, up to the maximum contribution. To contribute to a Roth IRA, you must stay below certain income limits. For 2022, single filers must have a modified adjusted gross income, MAGI, of $144,000 or less. Married filers must have a MAGI of $214,000 or less. Point 1. Contributions. Another major difference between Roth 401ks and Roth IRAs is the amount that you can contribute each year. 401ks, traditional and Roth, have much larger contribution limits, letting you set aside more than 3 times as much for retirement. In 2022, you may contribute up to $20,500 to a 401k combined limit for Roth and pre-tax contributions, and only $6,000 to an IRA. If you're 50 years old or older, you can contribute an additional $6,500 to your 401k, or an additional $1,000 to your IRA. 1. 401k contributions are made through payroll deductions, so you cannot contribute more to the account than you make from the employer offering the account. IRA contributions are similarly capped by your earned income if you make less than the typical annual limit. In some cases, employers will make matching contributions to their employees' 401ks and Roth 401ks. Typically, these contributions are made up to a certain percentage of the employee's income. Because IRAs are not related to your employer, there are no matching contributions on IRAs. For example, an employer might match 100% of an employee's contributions, up to 5% of their income. If that person makes $50,000 per year and contributes $2,500 to their Roth 401k, their employer will match that contribution, adding an additional $2,500. These matching contributions help employees contribute even more to their Roth 401ks. Required distributions. Some retirement accounts force you to start withdrawing money once you reach a certain age. With a Roth 401k, you must begin taking required minimum distributions, RMDs, by the time you turn age 72, unless you are still employed or own 5% of the business offering the 401k. Roth IRAs have no required minimum distributions, so long as the account's owner is alive. 1. Investment options. With a Roth 401k, your employer typically partners with a brokerage and offers a selection of investments that employees can choose from. This could include a list of stocks, bonds, and mutual funds. Some employers will give employees more flexibility, but many are stuck with a small selection of funds. With a Roth IRA, you have the flexibility to choose your broker and choose your own investments, as long as they are not prohibited to be held in a Roth account. Investing in collectibles via an IRA is generally not allowed, or may result in additional taxes. 2. Which is right for me? One thing to keep in mind is that you can open both a 401k and an IRA. If you're eligible for both, then it's a good idea to take advantage of both Roth IRA and Roth 401k, especially if your employer offers matching contributions. Common advice is to contribute to your 401k to max out your employer's match. After that, you can contribute to your IRA, where you have more flexibility to choose what you invest in. If you max out your IRA and want to keep saving, you can then return to contributing to your 401k. Of course, if you're only eligible for one of the two accounts due to income limits or not working for an employer that offers a 401k, you should take full advantage of it. Other information. If your employer or brokerage offers a Roth 401k or IRA option, odds are good that they also offer traditional retirement accounts. Traditional accounts let you deduct money from your income when you contribute and pay taxes on withdrawals. This is the opposite of Roth accounts, which are tax-free at withdrawal, but make you pay taxes on contributions. In general, Roth accounts are better for people in lower tax brackets who expect to be in a higher tax bracket in retirement. Traditional retirement accounts are best for those with higher income who expect to be in a lower tax bracket when it comes time to withdraw from their retirement account. The bottom line: Roth 401ks and IRAs are both similar, giving you a way to save money for retirement while receiving some tax benefits. However, Roth 401ks have much higher contribution limits at the cost of only being available through employers. If you have the option to use an IRA or 401k to save for retirement, it's well worth doing. The tax incentives can help you save even more for retirement.